Hello and welcome to Halftime Report. I'm Ekta Batra and with me will be Manglam Malu as well as Sonia Shenoy very soon. It's turning out to be a session where we are seeing some amount of consolidation on the screen, as you can see. So we have the Bank Nifty, which is just about flat with a little bit of a positive bias. We have the mid-cap index, which is just about marginally lower at this point in time. Remember that there are important global cues to watch out for. We do have the Fed chair speech, which will be taking place today at the Economic Club at Washington. And that will be important in terms of a cue, what the Fed is thinking post that stellar jobs report data that did come out for the month of January. Separately, talking about the macros, we do have the RBI policy tomorrow. And remember that the Reserve Bank of India has already raised rates by over 200 basis points since May of 2022. So the street is anticipating, with the fact that inflation is at 12-month lows, which is the India CPI, that means that the RBI could probably just about hike once more and stall. The number of people who would actually be voting for a hike will also be quite important to see in terms of what the RBI is thinking on a long-term basis.
Hi, Ekta. Well, absolutely. For now, it's like so quiet, right, for the market. At that 17,800 mark is where we are seeing a bit of resistance. But Tata Steel is clearly the big stock of the morning, or the afternoon rather. It reported a net loss of over 2,500 crores in the third quarter. The EBITDA missed estimates by a huge margin, while the margins contracted on the back of weakness in the European business. Nigel managed to catch up with TV Narendran, the MD and CEO of Tata Steel, to discuss about the company's Q3 performance. Began by asking him about the pricing trends that the company is witnessing in India as well as in Europe. Listen in.
So as far as India is concerned, it's reflecting international pricing trends, because international prices have gone up by about $100 per ton in the last 4 weeks. In India also, the prices have started going up. So we see month-on-month prices going up, as it did in January. It will continue to do so in February and March, because prices had come to a very low level in Q3. So, so if you look at it on an average, on a December to March kind of pricing, I would say it will increase by about 6,000 to 7,000 rupees. But when you look at it on an average to average basis, it will be a bit different. Because if you remember, in Q3, October prices were high, November it dropped, and December it dropped again, and before it started picking up. So on an average quarter to quarter, we will see prices in India up by about 1,300 to 1,500 rupees per ton across the product mix. Because you should also remember that the auto contracts are at a lower price in H2 compared to H1. So these are things that we need to keep in mind. As far as Europe is concerned, the spot prices have started going up. But you have the long-term contracts, which are typically negotiated in December, January. So there, the long-term contract pricing, which is always above the spot pricing, will see a drop. And hence, the European realizations for this quarter, we expect it to be about 70 pounds per ton lower than Q3, because it will be more reflective of the longer-term contracts, and the spot prices have not yet caught up with it. So that's the way we see prices. But the cost reductions in Europe will continue, because Europe in Q3, while the input cost came down, because we took an NRV loss, you will see that the cost has gone up by actually 31 pounds a ton, Q3 compared to Q2, which was not what the market expected, because the market was only looking at the coal and the iron ore prices, but not have that in Q4. So we see costs in Q4 going down by at least 100 pounds per ton in Europe compared to Q3. So you will see the negative EBITDA that we are seeing in Europe in Q3 reduce in Q4. We are not fully out of the woods yet, because the demand in Europe is still a bit fragile. Costs are still higher than long-term averages. But India is obviously going from strength to strength quarter on quarter, because in India, the demand is on, the prices are going up, and we've got our Nilachal capacity on track.
Okay, all right. Just to clarify that, on the European business, the losses will come down from around this $95 per ton, right? So should we work with a EBITDA loss of close to around, I mean, there was that NRV that you were talking about as well. Give and take everything, does it come down to sub $50 per ton in Q4 at current reckoning?
Well, that's what it looks like. But like I said, a lot of moving parts yet in Europe because of the dynamics of gas prices, energy prices, and steel prices.
Okay, all right. For the, the other aspect is the coking coal cost. What kind of a relief was seen on coking coal cost, both for India as well as for Europe in Q3 in comparison to Q2? And in Q4, what kind of relief can we look forward to?
So if you look at coking coal prices, both Europe and India had a $80 to $90 per ton benefit in Q3 compared to Q2. I'm talking of cost at a consumption level, right? In Q4 compared to Q3, it will be less, maybe about $10, because if you notice, the coking coal prices have actually started going up already, because it's reflecting the reopening of the Chinese economy and steel prices firming up. So the coking coal consumption benefit Q4 to Q3 will be about $10 a ton. Iron ore in Europe, we had a $20 per ton benefit in Q3 compared to Q2. It will go up by about $10 in Q4 compared to Q3, because iron ore, which had gone down to about $90 a ton, is today at about $125 a ton. So, but the bigger impact in Europe is going to be the energy costs and the gas prices going forward.
Okay, and the India EBITDA per ton then, from around, this 10,500 rupees per ton, we could add a little bit to that. That would be basically the increased prices of around 1,500 rupees. And maybe some cost benefit as well, given that operating leverage will pick up. You have the export market as well. So do we work with the EBITDA per ton in that vicinity of around 12,500 rupees per ton at current reckoning?
I don't want to give you a specific number, but yes, things will certainly improve because the prices are going up and the costs are stable, if not going down. Also keep in mind, Nigel, that Q4 volumes will be higher than Q3 volumes, both in India and in Europe. So we have 500,000 tons of extra volume coming in Q4 compared to Q3.
So how far am I off the mark at 12,500 rupees?
Not very far off the mark.
Okay, all right. Let's focus on the European business then. Time and again, when things get a little bit jittery, you need to take some strong stance out there. Are you looking to shut down the business if those discussions with the UK government don't progress? Is that a thought that you'll have considered?
So, Nigel, it's obviously a very complex call to take, because any decision you take has costs linked to it, right? Yeah. So we are evaluating, obviously looking at all options. We've got a proposal from the UK government. Let's see what that means, and can it work? Because there are two aspects to the operations in UK. One is the capital support required for transition, and the other energy costs. Energy costs last year across Europe has been 5 to 6 times what it traditionally is. So it was not a small number. Now it's settling back to longer-term normals, still higher than longer-term normals. So based on the forecast on energy prices, the commitments the government is willing to make, etc., we take a call going forward. And like I said, all options are costly options, so we need to look at what is the most optimal decision for us as Tata Steel.
You're looking at transmission to green steel, and for that you'll require support coming in from the UK government, £2.5 billion, I think so. Has there been any progress out there? Have you heard from them?
One is that number was speculative. That's not the correct number. The correct number is lower than that. I think the principle of support that we sought from both the UK government and the Dutch government is what other steel companies are seeking from other governments in Europe. I think the principle of support which most steel companies, or pretty much all steel companies, are asking for is at least 50% of capex support. Okay. And some OPEX support, because when you transition from coal to gas and gas to hydrogen, there's a risk you're taking on terms of input costs. Okay. Coal prices are a bit more, the steel industry knows the coal prices because metallurgical coal prices depend on steel prices, whereas gas prices don't depend on steel prices, right? Hydrogen prices will not depend on steel prices. So we are looking at some OPEX support, not just us, steel industry in general is looking at some comfort or stability on input costs when you switch from coal to gas or gas to hydrogen. So these are the two principles of support being sought. Okay. I think Germany, the country, has already offered some support to some of our peers in Germany. Yes. We also want to ensure that there's a level playing field, because it will be unfair on us if somebody else gets the support and we don't get that support, because we compete with them in the same market. So I think these are the conversations going on. The European governments are also looking at the Inflation Reduction Act in the US and the impact it will have on investments in the US, and hence the need to look at the incentives being offered in Europe. Okay. So I think there are moving parts on this, and we expect things to get clearer over the next few months. Maybe by the next quarter, we'll have some further clarity on this aspect as well. But Mr. Narendran, final couple of questions before we let you go. Europe moves back into the green by the first quarter of next fiscal at current reckoning. If things change, then obviously, we can't hold you to that. But at current pricing, at current demand scenario, at current raw material cost,
Europe goes back into the green, first quarter of FY24?
So, Nigel, there's another thing which we have in the first quarter of next year, which is the relining of the blast furnace in Netherlands.
Okay.
So that's another major operational activity which is, which is going to happen. So one of the reasons why we had an NRV loss in Q3 is we had to build up stocks so that we don't lose sales in that quarter, right? We have an unusual kind of sequence of events, between last quarter, this quarter, and next quarter. So I would say these are the three challenging quarters that we will have to deal with, and hopefully we'll have better stability after that. Let me put it that way.
So one difficult quarter, the coming quarter, and another one. Hopefully by the first half of FY24, Europe moves into the green.
Absolutely. That's what we hope. That's what we want.
Very quickly, Mr. Narendran, what about the debt reduction plan? $1 billion, is that happening or not?
Not this year. I think, that has always been the intent that we said, and there are years when we did better than $1 billion, as you know. This year, I think last quarter, if you look at it, despite all these challenges and the bad set of numbers, if you see the debt has stayed where it is at 71,000 crores, it has not gone up. This year, obviously, we also had to contend with the 12,000 crore acquisition of Nilachal, plus a lot of money which got stuck in working capital because of high input costs as well as the stock buildup in Netherlands. So we'll be releasing that cash for next year. Obviously, next year is a year when we'll get back on track, and we want to continue with our focus on debt reduction.
So next year, $1 billion is what you could do, FY24.
Certainly, that's what we'll chase.
And for this year, you end the year closer to these levels itself?
Well, we want to do better than where we are today, but let's see how this quarter pans out.
So a couple of thousand crores reduction from here, from the 71,000, 72,000 crores odd. Is that possible?
It's possible.
Okay, that was a very exhaustive chat with the management of Tata Steel. Let's slip into a short break. When we come back, we will have the management of ACE or Action Construction Equipment. Saurabh Agarwal of the company will be with us to discuss their Q3 numbers. Stay tuned.